Welcome to Chapter 1 of our series, Credit Score Roadmap, From Confused to Confident 680. In this episode, titled, Save Thousands on Interest, Why Your Credit Score Matters, we'll explore how your credit score can significantly impact everything from loan rates to housing options and even job prospects. So, if you're ready to take control of your financial future, let's dive in. Most people's credit score moves less than the distance between two-letter grades in school. Yet that tiny shift can quietly cost more than a luxury car over a lifetime. You're paying for money itself. In this episode, we'll explore how a small score bump can rewrite that bill. Here's the part almost no one sees. Lenders don't just glance at your number and shrug. They sort you into pricing buckets, and each bucket has its own interest rate menu. Move up one bucket, your cost of borrowing drops. Slip down one, and you quietly start tipping the bank every month for the same loan your neighbor gets cheaper. The wild part? Those buckets can sit only 20 to 40 points apart. That's less than the swing from a busy holiday season or one forgotten bill. On mortgages, auto loans, even some insurance policies, that tiny shift can separate people who look identical on paper. Same income, same car, same house. Radically different lifetime costs. In this episode, we'll zoom in on those cutoffs and show how staying just above key lines can keep thousands in your pocket instead of your lenders. Here's where it gets real. Your score doesn't just affect big milestones like buying a house. It can shape everyday choices you barely connect to credit. Landlords may decide how much deposit to demand. Auto lenders might steer you toward shorter terms or push pricey add-ons to get you approved. Credit card issuers can bump up your APR or shrink your credit limit, which then makes it easier to max out and harder to climb back. Small, routine decisions, where you live, what you drive, how much flexibility you have in an emergency, quietly bend around that three-digit number. Let's zoom in on how those few dozen points quietly change the math on your life. Start with mortgages, because that's where tiny differences hurt most. Lenders don't see almost the same score, they see different risk bands. Slide from the low 700s into the mid 700s, and you're suddenly offered lower rates, fewer junk fees, and sometimes easier underwriting. On a 30-year loan, even a quarter-point rate drop can equal more than one full year of payments over the life of the loan. Same house, same salary, same down payment. Just less money leaking out each month. Auto financing works the same way, but on fast forward. Dealers often mark up the rate they get from the bank. If your score puts you in a weaker band, there's less competition for your business and more room for them to pad your APR. That's how a great deal on the car can still be a bad deal on the loan. Stronger scores flip the script. Multiple banks are willing to fund you, so the dealer has to sharpen their pencil. Now stretch this across everything you might borrow for over decades. Student loan refinances, personal loans for big expenses, 0% promos you actually qualify for and can use strategically instead of desperately. A 20 to 40 point swing doesn't just change one contract, it shifts what's on the table every time you need money. This is also why timing matters. Many big purchases have a credit check moment where your recent behavior counts more than usual. Running up cards before applying for a mortgage or letting a single bill slip 30 days late right before an auto loan can nudge you into a more expensive lane for years. Think of it like changing the weather around your finances. A slightly warmer climate melts the ice on the roads. Suddenly, everything moves easier and with less friction. In a colder climate, every trip is slower, riskier, and demands more fuel. The paradox is that people with the least margin for error often face the harshest pricing when they do borrow. That's why treating each major application as a performance date for your score is so powerful. You don't need perfection, you need to cross the right thresholds at the right moments so the offers you see are built for someone the bank is competing to serve, not merely willing to tolerate. Think about three friends standing side by side at a dealership. Same model, same trim, same down payment. One has a thick, boring history of on-time payments and low card balances. Another just paid off a collection and carries cards near their limits. The third opened several new accounts in the last 3 months. The cars they test drive feel identical, but the loan offers they get are quietly customized. One sees preferred terms, one gets standard, the last is offered approved with conditions. The difference isn't just the rate, it's the options. Longer terms, lower required down payments, even whether they're pushed toward leasing versus owning, can shift based on those patterns. Zoom out and you'll notice this in unexpected corners. Who gets pre-approved mailers? Which balance transfer offers show up in your app? Whether a bank proactively raises your limit or leaves you stuck. Your past behavior scripts which doors swing open automatically and which stay locked unless you beg the gatekeeper. Rising use of buy now, pay later, rent reporting apps, and side gig deposits means your money habits are leaving more footprints than ever. Those patterns can quietly tilt future offers. Flexible limits when cash flow swings, smoother approvals when you switch jobs, or faster rate drops after setbacks. Your challenge this week: pick one account you use often and read the fine print on how they report data. Note any behaviors today that could echo into tomorrow's terms. Over time, patterns you treat as background noise, like routinely paying subscriptions late or co-signing just this once for family, can echo louder than big, rare events. They color how future offers are framed, entry-level or VIP. You don't need to overhaul everything at once. Shifting one quiet habit can tilt the whole trajectory of what you're offered next. Before next week, ask yourself, 1. If I applied for a car loan or mortgage tomorrow, what exact interest rate do I think I'd be offered based on my current credit score? And how much extra would that cost me over the life of the loan? 2. Looking at my last month of payments, where did I cut it close or pay late, and what specific change, like moving a due date, setting an automatic minimum payment, or paying twice a month, would most reliably protect my score? 3. Which single high-interest balance is hurting my utilization the most right now, and what concrete dollar amount can I commit to paying toward that one balance this week to start lowering my overall interest cost? This was Owl Up, your daily step forward. To keep learning with structured courses and more insights, go to owlup.co. Until tomorrow!